Thank you all so much. Everybody in the webinar is so early that people that actually log in on time at 8 o'clock, they're going to be mad at us. But I'm excited. I'm excited that y'all are so early. So that means that you are excited. So I can get excited. Hey, we have people that have called in on the telephone also. That is fabulous. Fabulous. Thank you so much. How you doing, Natasha? Thank you. Thank you. I appreciate you all more than you could possibly know. Your interest in investment performance and how to measure your performance. Wow, this is the first time I actually have the block right here. You can go to AfroEconomics.com, and if you click that block, you can actually open up your investment account. You can open up a retirement account, a joint account, a joint regular account. You can open up investment accounts. You can even put money into the account. How about that? AfroEconomics is high tech. Yes. Yes, indeed. I just don't talk about it as much as I should. You should start at 7:59 saying you get a car and you get a car. Exactly. And then at 8 o'clock, the people will really be mad. You get a car and you get a car. It's at 7:59. Yeah, they would be mad if I said they were going to get a car and they didn't get a car. Or it'd be like a little teeny like cartoon car. Like, what is that? Golly, my child's getting old. I don't even remember what little cars are called. Yeah, like a matchbox. But then I had a girl, so she never really had little cars. She had zero interest in little cars. She's all girl for real. Now I know, and I have a motorcycle, and she never wants to ride it. And I've always said, well, I bet if I had a little boy, I wouldn't be able to keep him off that bike. She's like, walks around it. It's in my way. Move that thing. So I tell you, you never know what your kids' or interests will be, but it's a blessing. She adds so much joy to my life. She's probably listening somewhere. I love you. Thank you all so much. We're going to get this party started. We're talking about investment return, how to judge your investments, because it's that time of year. Everybody's getting their statements and they're like, what? Yeah, I know that's right, Luanda. You're like, whoa, I am so happy. No, but there are some people who are unhappy. There are some people who are very happy, and there are, just people that haven't even checked their statement. They get it in the mail and they don't even look at it. They don't even care. They have no idea. I know people who have left money back in old jobs, and we're talking about judging performance. They don't even know what they have in the account because they left the job years ago. So you all, I commend you for not being that type of person, because you can't be that type of person and taking the time out to do a webinar talking about investment returns. But I have thought about this topic for a long time, and I've said, like, will anybody be interested in it? And, because sometimes things that interest me because I'm real techie and this is what I do, like, the aren't of interest to you. So I appreciate you being interested in how we really should look at these things, because a lot of you are like getting statements and say your statement is lower than it was last year. Like, say you didn't add any money all year and it's just a lump sum, and last year you got a 10% return out of the investment, and this year you're saying it really didn't change. So you're saying it didn't go down, but it didn't really change. It's right there. It's about $1 up. And then you're wondering to yourself, like, is that good, or is that bad? Because you're really, you could even be disappointed because it didn't go anywhere. And then, so it's really important for you to get an idea of, how do I judge this? Like, because everybody's been watching the news, and near the end of the year, you had, some major dips in the market. So then you have that consideration of like, wow, well, at least I didn't lose anything. So at least I have what I started the year with, and then you have to wonder like, well, what about my portfolio allow me not to go down when it's saying that everybody else is going down? Well, you got to stop yourself, because just because the news is saying that, the news is talking about, that's where the whole benchmark term came in, because the news is talking about the Dow Jones. It's the 30 stocks that make up the Dow Jones Industrial Average. So your portfolio, or they're talking about the S&P 500. So your portfolio is not exactly that, because you cannot invest in that exactly. Now, you can't invest in an index. You can invest in something that is modeling the index, but you cannot invest exactly into that index. But those indices are often used to benchmark. So we'll say, well, the Dow, dropped, so you assume that that's going to happen to you as well. But your portfolio may not be made up of just Dow components. So you may not have that same dip. So my point here is to say that when you benchmark, make sure that your benchmark is relevant to what you're investing in. It's got, where you have to compare apples to apples. You don't want to compare apples to oranges. You have this, portfolio that has bonds in it also, and you're comparing it to the pure 100% stock index of the S&P 500. So be very conscious of when you're comparing your portfolio that's made up of a broad investment range, and then you're comparing it to an index that's only 100% stocks, you're not comparing apples to apples. You're comparing apples to bananas. So when you invest, it's important to remember also what you're doing. Why are you investing? Why are you doing? Why did you put this money away? Because your objective is what? You're investing to create financial prosperity, or you could be investing to create security or to attain a goal. But we have to know, and that's the first principle of AfroEconomics is, why am I investing? Know the goal. That's why this weekend we're going to do the workshop about creating the lifestyle of AfroEconomics, bringing it into your life, because first we've got to know why we're doing this. Why are you doing this? So when you get this investment and you're investing because you want to create financial independence at a particular age, or you want to grow something that you want to leave it to your beneficiaries, then you set what that is, you start doing it, and then you start looking at your performance. And then we forget that we want to look at the performance over a particular time period also. So if you're comparing it to how the Dow did last year, your stock portfolio, you said I want to outperform the Dow Jones Industrial Average, but you're not looking at how the Dow did over the last 5 years, or your portfolio, or you might, if you have a long-term portfolio, hopefully you have 10 years, then you want to look at how did your portfolio perform over the last 10 years or the last 20 years if you can. But you have to make sure that you don't take 1 year performance of the Dow and use that as your comparison, and then you're looking at your investment over a different period of time, or you're looking at the 10-year performance of the Dow, and then you're looking at how your investment did over this last 1 year. So make sure that you consider the time when you go into comparing how your investments did relative to something else, right? In measuring your success. So I want to make sure that you feel comfortable asking any question on this, because I'm just going to continue to just like try to express this in the best way that I can, but it's so much more fun talking about this when you ask me a specific question so that I can, so, but I also want to make sure, so I put down, look at my notes all scribbly, but I know what this says, that measuring your investment success. Some people do it based on just your principal. No matter how long you've been investing, they go, well, I got more than what I started with. You know, like they put $10,000 away 10 years ago and they have $11,000. They're happy because their benchmark that they've created is their principal. No, but is that really enough? Well, if you don't understand what you're investing in or what you invested in, then, you know, I guess, you know, Mr. Moore, right? That would be enough. Because you're just like, you're a happy camper. And I would say that a lot of times, if we don't get the most success out of our investments, because I hear it all the time. People will go, oh, I have an investment over such and such and such, and I made money. You know, it's a good investment. You said you refused to look at your statement again. Oh, you're gonna be all right. Yes, and they'll say, you know, that they don't even have anything like relative to what they're not even seeking to make sure that they manage it well. They're not even, you know, trying, because they're just like, oh, as long as they made $1, or as long as it's, you know, that is here's 20 years later, you know, and that is a problem. That is a frequent problem of not making sure that you have a particular goal of what especially if you have time. If time is on your side, it'd be different if it was like, oh, well, I would need it next year. So if you still have what you started with because you have a short-term time horizon, then that's okay. But that's not it's just too frequent in our community that we are just falling victim of high fee investments that are pulling down your return, and you're not benchmarking, you're not comparing it to anything else. You're not even shopping. You're not talking to anybody about what you're doing. So the first thing when a person signs up for AfroEconomics as on a membership level that allows for the comprehensive financial planning. Now, of course, if you're doing the free membership, you know, you're not going into the comprehensive financial planning, but at a comprehensive financial planning level, that we have to look at what you have. And then I can tell you if it did well because it outpaced your particular benchmark or what I think you should be comparing it to. Because we got to be comparing apples to apples. I guess if you have CDs, you know, then we're going to say, yes, this CD, you know, did as well as all the other CDs, right? It did pretty well. But if you have it in a CD, but you actually you wanted it for long-term growth, then, you know, the CD over the 20-year period most likely did not outperform a good growth portfolio or even just the index. So and when I say index, I'm referring to the S&P 500 index. You know, over the long term, the, you know, S&P index has outperformed a basic bank CD. So what it goes back to what was their why? When they got that CD, you know, was their why to make sure that it was outpacing the indexes, or what? At least outpacing inflation, which is my fourth point on my page. And I skipped from 1 to 4, but I think that the best benchmark, because, you know, we might not live to this, so I got to tell you right now, I think that the best benchmark is to make sure that you're at least outpacing inflation. Outpacing inflation. So our inflation rate is around 2% now, but then you're paying taxes, so you have to have a return that outpaces after inflation. The real return is at least outpacing inflation, and a lot of people aren't even doing that. No. So even though it might be going up and it's up, their buying power has been lost because they haven't outpaced inflation. And then that's where the measured risk comes in, because it's like, well, we don't have to have, but wise investing would encourage you to make sure that your portfolio is at least outpacing the cost of living increase so that you can increase your standard of living. I don't want to just keep pace with inflation. I want to outpace inflation. So another benchmark would be risk. And you have to be comfortable with risk to some degree in order to outpace inflation. But a benchmark is risk, because when I take a portfolio and I get what your risk score is, how much volatility you're comfortable with, and then I get a particular risk score for you, and then I put your portfolio into the algorithm, the software that I have, and then so you have an 80 risk score, but your portfolio is at a 30, then that means that you have not been allowing yourself to invest in growth opportunities that you would have been comfortable with. Theoretically, you should have had more things with growth potential. So you should have had more stocks or mutual funds or stock exchange ETFs in there. So when you add more growth-oriented investments, your risk score will go higher, but it would have matched, the portfolio would have been more appropriate for your specific goals and your particular time horizon and your particular risk that you were willing to manage. A lot of people just go, oh, well, it's not going to go down, and then they just jump on it, but they don't realize the risk that you're taking when something is not going to have any growth or it's not going to outpace inflation. Now, that doesn't mean that all portions of your portfolio have to outpace inflation, but we have to have a good asset allocation that you understand. And that's why I love when I'm able to, this computer and these algorithms make my job so much easier, because I can put together all of these different investments and get you to a risk score that you're comfortable with. So I say that risk is a benchmark because, we have words that we use like your alpha score and your standard deviation and your beta, it gets deep, but it's all in that risk score. It's all considered in the algorithm. That makes it a little bit easier for you to understand as an end user how risk and return relate to each other, versus me giving you big words that are totally are not really relevant to you. They're relevant, but they don't give you the power that you need to make your financial decisions. So we put it in there and we make it so that you can understand that a higher risk score means, and that might be a higher standard deviation. It might be that, might also be a higher beta on the new portfolio, but it's your higher risk score is allowing you to put more growth potential in there. And then hopefully you'll increase your chances of outpacing inflation. It's because you have some growth potential. And there was a question. Mr. Jones says, what exactly is inflation? I understood it. It's the opposite of what I think it is. So what do you think it is? But they put together all that we're paying. So all that we're buying in prices, and then the government puts together all of these things, and they put together your for our country the summary of all things that are bought, and the price changes over time, and they get the rate of how these prices of these goods changed over time. So I was looking at a report today, and in the last quarter of 2018, inflation rate went down a little bit below 2%, and they were saying because gas prices went down. But basically, 2%, you want to make sure that you are outpacing or having a real return that's outpacing 2%. And then, and a real return, I say, because you can get a 2% return, but it's taxable return. So then you didn't actually clear that 2%, because you had to pay taxes on it. So the real return might be only 1%. So you would have to exceed that 2%. You may have to get 5%, depending on your tax rate, in order to clear at least that 2%. But some people, their withdrawal rate on their investment exceeds the growth of their investments, but it also is exceeding the inflation rate. So if you're clearing just the inflation rate, but you're spending 4% and you made 2%, then you're still losing 2% on your principal amount, right? If you're trying to make sure that that money lasts forever. So that's why I say our goal is to outpace, inflation. Not to say that you should be happy because you got a positive 2% return because you're outpacing inflation, because you also have to consider your withdrawal rate and your tax rate on the withdrawals that you're going to be taking. So, would you be happy with only 2% of your money? So that's 20,000 for every million. You get 2%. You're taking out 2% because you're being so conservative. No. So we got to seek out investments that will give you a better return so that you can grow your money and still get the income from it. Isn't it fun? So when you structure your investment portfolio your investment portfolio, how long is long term? Is there an exit criteria? How can I convert all my salary into capital gains to target the top fixed, right? He said, how can I get all of the salary and make it into a capital gain? My brother, you would have to totally you'd have to join my world of owning your own business. Yes, indeed. So then, say they own their own business and they sold, just say you're the owner of Facebook. He can say, skip the salary, he don't pay himself any check, right? And then, but he lives off, he has the stock, so he sells the stocks. That's how you live off the top tax, that's why, like how Warren Buffett was saying, that he pays less, a lower tax bracket than his secretary. Well, that's because, he can just skip the salary. Who wants a W-2? You know what I'm saying? You're the boss. Skip the salary, sell your stock, you got a lower tax bracket. Wow, I wish y'all were talking to me. And then when you structure your investment for what is long term? Long term, definitely is 10 years, in my opinion, 10 years or more. I remember back in the day, you'd be 5 years, you look at the 5-year return, 5 years, yeah, that's long term. But no, I want more. I want to be able to show you, 10-year performance. No, especially out of the majority, I might have some components in the portfolio that don't have the 10-year numbers, but I want the majority of what I'm putting in a portfolio to have 10-year numbers. But that I could show you even, for long term. But as far as for you to think of long term, I think you should, if you're putting away into something, if you said, I really want to straight up speculate, you definitely should be looking at, 10 years. That this is something that I believe that in the next 10, 20, 30 years is going to really be something. And look how the person who, you know, who did that in some of these texts that we have now, if they had that kind of insight, you know, and patience and commitment to the long-term market, you know, they benefited, you know, tremendously. Right? And that's all of you, you know, most of you on this call. Like the S&P, you know, the S&P is common in a whole bunch of your stock portfolios at work, and the you know, that you're still, so you've been investing in that, you know, throughout your 20, 30-year career, you know, you're doing it. You're doing it. You're doing it. You just don't see it directly. But, and that's why I like, you know, for us, you know, to when we meet, to just talk more times about what is in it, what you actually have. Like one time I had a meeting and the man came in and he was like, you know, talking to me about what stocks he wanted. You know, it was like, this is really good. And then, you know, I had to show him that the ETFs that he had already had those stocks in there. So, you know, did he want those individual stocks, or did he want to acquire more of, you know, the ETFs that were giving him the instant diversification because he was a small investor, you know? And then he said, oh, well, I'll just buy more of that, you know, than one or, you know, two shares of an individual. Like you just, so it's, you know, it's about talking, it's about communicating, it's about getting a better understanding of what you got and what you're going in, what you want, where you're going, where you want to get to, and how you're going to do it. And, you know, and just understanding that how you judge your investments has to be based on your specific goals, not just on what it's doing right now, but on what your long-term expectation is of it. What have the same things that are in the same community, and I look over that way because y'all look, I'm looking at your face because I'm looking at your name. And then when I look at the video, I go, why was I looking in that corner? But that's because they're over there to me, right? But make sure that you are, when you say, oh my goodness, and I hope that, you know, that you all realize this, that when you're looking at your investments, make sure you're comparing them. Your investments should not be compared to your savings account. Your savings account is not going to have volatility. It's not supposed to. So you know how people go, well, Dad, that went down, I might as well have had it in my savings account. But they never say that when the market is up. They never say that. So it's like, don't say stuff that, you know, is totally off base, and don't frustrate yourself, but realize that, you know, make sure that you're always comparing oranges to oranges, apples to apples, bananas to bananas, even if they're inside the portfolio. Because your portfolio, you have a portfolio made up of, you know, cash, bonds, you know, and all of these different equity sectors. And then you want to compare it to something totally different. Well, no, only your bond section should be compared to your bond index. And then your stock sections can't just be compared to all the S&P, when you may have a small company stock fund, or a lot of small company stocks in your portfolio, or just have a small company stock portfolio that can be compared to the S&P 500. Those are large caps. So let's be aware of that. And then also you could measure your performance based on the amount of risk that you're exposed to relative to the performance. So it might have, you know, extremely high risk, and you're happy because it only went down 5%, because you are aware of how much risk you were exposed to, and other like investments that are in that same category went down 20% theoretically. So you know that even though it went down 5%, it still outperformed its sector. those like it. And then we talked about inflation, and that was my final point, but I think I got that out there. That a good benchmark for us to get a better understanding of it is, that we want to outpace the cost of living, in our investments. And when we say that we want to outpace the cost of living, in your real return, after your taxes, after the expenses, the less the expenses you can get in your portfolio, the better. You can get into a situation like with the AfroEconomics portfolios that have very low expenses, and you're compare it to something where a lot of people are doing that have 4 or 5% versus 0.02 or something like that I've seen in my portfolios. So you want to make sure that you investigate the expenses that you're paying that are pulling away from your performance. Because the expenses that they have in how you're investing, that is, you receive what is left after they take out all those expenses. So if you invest in something and it says we have a 4% load, or we have a 2.5% load, or we have, what are you getting for that? Be aware of that. Make sure you know what you're doing. So that's a huge benchmark of just knowing, that if you put yourself in a position to avoid fees, you already or lower or cut your fees in half, then you've already, helped yourself. But we often overlook that. And we are, suited or pursued a lot by investment companies and categories and that have a lot of fees, a lot of expenses, transaction costs, that we have to be careful with. We do. So that's what we're there for. That's what AfroEconomics is for. We put everything into the system. It shows us what the expenses are. A lot of stuff, some of this crazy stuff, I think one people I was meeting with, and I looked up their things, and I was showing them the crap that their portfolio was in. And they're like, this was a big trading house. They were like, oh my God. There's one lady, I would say liquidity can also be considered into how you judge your performance. You can't, if liquidity is important to you, that needs to be added into your criteria. You find yourself into something where you can't get out of it but every quarter, or you can't get out of it until only once a year or whatever, factor liquidity into your benchmarks of investment performance. And we can talk more about this because I may have said some things that just work. But Dr. Williams, let me know if you want to talk more about converting all salary into capital gains. I hope I, really touched on that. But that's a very good question, and that's where I want us to be thinking. That's it. Y'all have a wonderful, wonderful evening. Can't believe I talked this long. Oh, thank you. Yes, indeed. I hope you all enjoyed it. Hey, to all the callers, I can't see you, but I appreciate you. Indeed. How you doing, Maurice? I hope to see you this weekend in DC. Let's do it. The AfroEconomics lifestyle, and we'll talk more about this. All of this. Come with your questions. Email them to me ahead of time. God bless y'all. Be safe. Stay warm. It is cold out there. Check this out again on YouTube.